Question: who would pay $231,000 for Bitcoin when they could easily buy it on the market for $119,000? Answer: passive index funds. Index funds perpetuate mispricing, and investors are the losers. Last week I talked about index fund investing's undiscussed problem. With any level of mispricing, no matter how tiny, passive funds will mechanically overweight overvalued stocks and underweight undervalued stocks, creating a drag on portfolio performance. This is the topic of my recent paper with Chris Brightman, Passive Aggressive: The Risks of Passive Investing Dominance. Importantly, the mispricing need not be tiny. Strategy. Formerly MicroStrategy Corporation is a case in point. Strategy's main asset is 600,000 bitcoins that today are valued at $72 billion. Strategy has about $2 billion of other assets and $11 billion of debt. So, the net value of its assets is roughly $63 billion. But Strategy's value on the stock market is $123 billion. To be clear, Strategy's business model is to hold Bitcoin. It is not involved in any R&D that has a potential for a massive upside. Investors can hold Bitcoin by buying exchange-traded funds. Investors are buying Strategy at a 95% premium to its net asset value. Huge index funds are first in line to buy Strategy when new flows come in. The index fund does not care that Strategy's NAV is only $63 billion. The index fund only cares about one thing: Strategy's $123 billion market capitalization. In effect, passive pays $231,000 for a Bitcoin worth $119,000. The takeaway is obvious. Passive index funds don't care about fundamental information. They don't care that Strategy's Bitcoin is valued at a 95% premium to the net asset value. Passive only cares about one number: market capitalization. As such, index funds perpetuate any deviation from fundamentals. As the stock goes higher, the index flows add to the price momentum, intensifying the bandwagon effect. We've seen this movie before. During the GameStop frenzy, the stock price was driven far from the underlying fundamentals, and in January 2021, GameStop's market capitalization was an inexplicable $33 billion. To be clear, I'm not criticizing Strategy, Michael Saylor, or the crypto space in general. My issue is with the role of passive index funds. To emphasize, deviations from fundamental value don't have to be small. Further, passive investing exaggerates rather than corrects mispricing as new flows buy more of overvalued stocks. This problem is likely to get worse in the future. In the next 10 years, passive could rise to 80% of all investment. That does not bode well for market efficiency. We need to do better.